Hey everyone, and welcome back to Everything About Accounting. Today, we're tackling a term that can sound a little intimidating at first, but it's absolutely fundamental: debit. In accounting, a debit, often abbreviated as DR, simply means an entry on the left side of an accounting equation or a T account. It's not inherently good or bad. Its effect depends on the type of account it's applied to. Think of the basic accounting equation. Assets equals liabilities plus equity. Generally, debits increase asset accounts, like cash and accounts receivable, and increase expense accounts, like salaries and rent. Conversely, debits decrease liability accounts, like accounts payable and loans payable, and decrease equity accounts, like owner's capital and retained earnings. So, whether a debit increases or decreases an account depends entirely on whether that account is an asset, liability, or equity account. Every financial transaction involves at least one debit and at least one credit, and the total debits must always equal the total credits. This is the foundation of double-entry bookkeeping. So, to summarize, a debit is simply an entry on the left side of an account. Its impact, increase or decrease, depends on the type of account it affects. There you have it, debit explained in under 90 seconds. Hopefully that makes it a little less mysterious. Let me know in the comments if you have any questions. And don't forget to subscribe for more quick and easy accounting lessons. What equally important term should we explain next? Thanks for watching, and I'll see you in the next video.